So I want to talk all things macro with you. There's a chart I show all the time to my people because I just keep pointing at it going, this should cause more consternation than it seems to be. And it's just a simple chart you find on the the Fed data site, Fred. Um, line one, US GDP. Line two, total credit market debt, not liabilities, not under unfunded debt. Total credit market debt, not federal debt, because a lot of people focus on that. This other line is going like this. Credit has been accelerating at twice the underlying rate of exponential compounding growth of GDP for a very long time. And even Jerome Powell said, by definition, that's unsustainable. What do you make of that chart?
Look, I mean, it's funny, right? The chart speaks for itself. You don't need to interpret that. It's very, very straightforward. It's one of the most straightforward charts out there, and it's the reality of the world we live in. The question really is not what's happened or why it's happened, right? The incentives have been there, ever cheaper and more abundant access to credit, is the incentive. And as the late Charlie Munger, God rest his soul, famously said, show me the incentives and I'll show you the outcomes. So if you are going to lower rates and keep them low for 40 years, that chart is absolutely going to happen. There's no other chart that's going to take its place because the incentives are dictating that's the chart. The question is, does it matter? And the answer is yes, of course it matters. And then the question is, well, why hasn't it mattered so far? And this is the bit that is kind of tricky, right? And so when trying to figure out, does this chart matter? First of all, you've got the law of large numbers in effect, right? It's now such a big number that people can't get their heads around it, right? If you've got a salary of 50 grand and you owe 300 grand to the bank, you can put that in perspective. You know what your income is. You kind of know how indebted you are and how big a problem that is for you, right? You owe 6 times your salary, and you can think about, okay, how could I pay that back? It's a frightening but manageable number for a lot of people. It's past frightening because the numbers don't even really make any sense to people, right? What's a trillion? A trillion is one of those playground numbers that when you were a kid, you used to throw at your friends. We're into quadrillions when it comes to equity derivative exposure, and we're into quadrillions when we talk about the yen. So we're in these kind of made up numbers that people can't really quantify. And so when you can't really quantify the number, you can't really understand how big it is. And so you're left to kind of think to yourself, well, look, if it's that big a problem, it would have gone wrong. And the fact that it hasn't gone wrong means it's probably not something I should worry about, right? And if you haven't worried about that for the last 10, 15 years, and you've borrowed more money and you've become a part of that chart, life's been pretty good, right? So why would you worry about it? There's no need to worry about it. You've been able to borrow at will. You've been able to roll that debt over at increasingly lower rates, and you haven't had to pay it back. And you've used that leverage to, whether it's to buy houses or cars or boats or to invest or whatever it may be, life's been good. So that chart, as ridiculous as it is, it hasn't mattered. The problem now is obviously we live in a very different world. We live in a world where interest rates are going up and credit is not as easy to access for the man on the street. And the cost of funding that credit and the cost of rolling over those debts is going up. And so we are about to start seeing the downside of all this, and that's people going bankrupt and companies going bankrupt and debt being defaulted on and all those things. And once that cycle starts, and we've seen an increase in bankruptcies already, we've seen a significant increase in bankruptcies, we've started to see defaults, we've started to see companies going to the wall. Once that happens, then you start to think about what that chart means, right? You start to think to yourself, wow, there's debt defaulting. How much debt is there? And then you start looking at the charts like this, and suddenly it becomes a problem. And once it becomes a problem, people start thinking about it, then it kind of forces action. Now, it won't happen overnight, but charts like that, as I keep saying, I've said this in so many presentations, I've lost count, it doesn't matter to anybody until it matters to everybody. And that's kind of the way these things tend to end. Suddenly, it becomes a thing we need to focus on, and suddenly it matters. I mean, look at not to go down this rabbit hole, but look at COVID. When it was a strange thing in China where people were falling over in the streets, it was a curiosity, right? And everyone was looking at it going, have you seen this weird footage from people collapsing in the street in China? There's some weird Chinese virus going around. It was a curiosity. First cases show up in the US and Europe, and suddenly it matters, and we lock everybody down. So, that tends to be the way these things happen. They don't matter until they matter to you. When they matter to you, they matter a great deal. So I cannot tell you when that chart is going to matter, but I can tell you it's going to matter. And thousands of years of monetary history bear that out. We're just in the process now of how do we extend this? How do we keep this going for longer in the hope that a solution magically presents itself? And unfortunately, in the case of debt, there's three solutions, as we all know, right? It can be paid back, which one look at that chart tells you there's absolutely no way that debt's going to be paid back. It can be defaulted on, which in a rising interest rate environment becomes more and more likely that more and more of that debt gets defaulted on, or it can be inflated away. And so that's the preferred option because it's a stealth option and it doesn't involve headlines about rising bankruptcies and rising defaults and things like that. But getting that right in a world that has so much liquidity sloshing around with it is proving much harder, I think, than the Federal Reserve would like it to be. That 2% inflation rate is lovely, right? That's a really nice number to get, so they can achieve this over time, and that's what they're trying to do. But we're not there, and we're not going to be there. We are going to have to deal with this at some point, and when we're forced to deal with it, it's not going to be pretty. I mean, I wish I had better news for you and said that, yeah, this is going to be fine, but it's not. I just have literally no idea when it's going to matter.
I summarize all three of those options down into one sort of waggish sentence. People, I point to this chart and people say, well, what do you conclude from that? I said, there's really one question to resolve: who's going to eat the losses? And they're going to,
yeah.
And if you pay it back, that's future generations. It's their loss because we pre-spent their money, and now we have into austerity as we attempt to pay back what we already spent, right? So one way or the other is just I see loss taking in that chart, and of course, watching how the Dodd-Frank law got rewritten and they did bail-ins for banks to, the bankers are working very hard to make sure the answer is not them, right? The political class is working very hard to make sure it's not on their watch. And unfortunately, as it seems to be always the case, it's the people out there actually performing the valuable services of carrying the nation forward and putting their hard work and effort into having families, households, producing goods and services that are needed and wanted. They're the people who ultimately bear the brunt. I wish I could see it differently, but I don't see a way out of this at this point that doesn't have losses spread unequally.
The people that this case is going to matter to, unfortunately, the public are the only ones who don't have a voice, right? Who don't have a seat at the table trying to figure out how this goes down. You're right. The bankers have powerful lobbies that have made sure that they can ring fence themselves to the best of their abilities. It won't work for all of them, but the industry as a whole will survive and the big will get bigger. And obviously policymakers also have a big say in how this goes down, and that will be dictated not by prudence, but by protection of legacy and protection of institutions. And for all this to be happening during the fourth turning is no coincidence. This is what happens in a fourth turning. If you read Neil and Bill's tremendous book, then you realize that one of the characteristics of a fourth turning is the ultimate loss of faith and destruction of public institutions in which we've lost faith. And whilst people haven't lost faith in the central bank yet, and perhaps we should clarify that when we talk about people losing faith in the central bank, let's break that down into financial market participants and non-financial market participants. I think if you're a non-financial market participant, your faith in the Fed is wavering because they've become much more visible in the last 25, 30 years at their own insistence. Basically, they've inserted themselves into the public consciousness, starting with Greenspan. So they become more visible, and people have a better, if not complete, understanding of their role. And so the man in the street is not necessarily happy with the Federal Reserve and hasn't necessarily kept their faith in them. People in financial markets are different because, again, the incentives are aligned. All the people in financial markets care about is this Fed going to help us make money? And the answer has been an unequivocal yes. So until the Fed start losing people in the financial industry money, then faith, as it pertains to financial market participants, won't evaporate. Now, I would suggest that this year, since the events that caused Silicon Valley and Signature to go down in terms of the losses on their mark-to-market of their treasury bonds, that's probably the first sign of a potential avenue down which this faith amongst financial market participants can be lost in the Federal Reserve. So that's something that's important to watch. But now that faith on the part of financial market participants, it revolves around one thing and one thing only. Are you going to cut rates? Are you going to keep the game going? Are you going to increase liquidity? Are you going to do all the things that you've done at the first sign of trouble for such a long time now to ensure this party goes on? And so Powell's in a tough place because in order to fix the problem, he's going to have to disappoint financial markets. And I don't know. I think he wants to be ready to do that. And I think he's tried to use forward guidance in such a way that it's kind of reversed. He's trying to convince people to believe him that he is going to keep rates higher to try and take some air out the bubble without popping it. But ultimately, as we've seen from market pricing of interest rates for next year, the market's betting on 3 or 4 cuts next year. So they don't believe him. They don't believe that he's gonna do what he said. So that's his quandary now. Do I solve the problem or do my best to solve the problem and disappoint the last group of people that have faith in me and risk the chaos that ensues if financial markets become unhinged? Or do I risk the legacy of the Federal Reserve as an inflation fighting force and bow down and cut rates as the market's saying I will, so they can go, see, we told you don't have the cojones to do it. It's a very tough spot for him. And I'm pretty sure I know what he wants to do, which is be hawkish and stay higher. But I just don't know that he has the stones to do it. And I've he's fooled me once when he first took the role. I listened to him and I'd read some of his contributions to the Fed minutes before he became chair. And I tweeted, I remember tweeting this, I can't remember when it was, but not long after he took office, I said, I kind of like Jay Powell. There, I've said it. And I got so much abuse for it. And, and I said, well, let's see. But he definitely understands what's going on. You can tell that from the transcripts. He understands what the Fed has done. He understands why it's dangerous. Maybe he'll fix it. And of course, I've been proven totally wrong. So for me to believe that he's going to suddenly turn into Paul Volcker II and stick to his guns, what's that famous George Bush saying? Fool me once, fool me twice, you can't fool me again.
Yes. So I'm okay. Let's go on Jay Powell because I am confused as well. I go back and forth, and I actually think he's trying to have his cake and eat it too. And this gets a little wonkish, which I know you can entertain, but for people listening, this actually really matters a lot. So there's the things that are we talk, the headline stuff, which is mostly bollocks, right? The Fed cares about full employment and stable prices, right? Not really. What do they care about? They care about financial system stability. That's the bedrock of their mandate. Make sure that the banks are happy and healthy and whole. Okay. Prior to 2008, if we went through an interest rate hike campaign, and I spent a lot of time studying this, as I know you did, but here's how it would work. The Fed didn't have a magic dial. They could just say the rate is now 2%. They would have to go out into the open market of all the banks, the ecosystem, and they would have to withdraw cash. And they would start taking cash out of the system and putting back, assets, treasury bonds or their equivalent, mostly treasury bonds pre-2008. And eventually there wouldn't be quite enough cash out there and banks would charge each other marginally more for the overnight and the overnight rate is what they're tracking. So it was actually this thing where they had to pull cash and then watch. And that's how they did it. Then under Bernanke, probably the biggest single change of my lifetime, they said, oh, we're going to start paying banks interest on excess reserves. They make huge amounts of excess reserves, flood them out there. The banks put them back with the Fed. And the Fed says, oh, we'll pay interest on this. Well, all they have to do is pay 3% on these and magic, the market rate's now 3%. Because why would you get less than you could get from the Fed. In fact, it's probably marginally higher out there in the real world. So now they did have a magic dial, but the mistake would be to think that hiking rates today is the same as tightening, because tightening meant pulling cash out of the market. Things got financially tighter. So that's why I've been mystified watching this whole thing go. The Fed's, working its balance sheet down pretty aggressively, and nothing is happening to my financial liquidity indexes. But that's because there's still nearly $800 billion of excess reserves just parked out there. It's a huge pile of money. Do you agree? I mean, is the plumbing important to understand if we try and make sense of things today?
For sure it is. Yeah. I mean, look, plumbing is very important to understand, and it's deliberately opaque, right? It's kept that way for a reason, because the more complicated it is, the easier it is for people to go, oh, it's too hard, I don't want to understand it. And understanding it is incredibly crucial thing to do. So look, they're trying everything they can to talk tough in the hope that words will matter. Now, words mattered in the other direction. Obviously, when they talked about we're going to keep rates low for an extended period of time, everybody went out and borrowed. But again, the incentives are just so completely misaligned. Of course, people are going to go out because there's money to be made here. So your words are going to be much more powerful when you're whispering sweet nothings in the market's ear than when you're telling them you're going to punish them. People don't want to hear that. We're not inclined to hear bad news. We'd much rather hear good news. So yeah, the plumbing of the markets is incredibly important, and what they're doing at face level and what's happening in the background. You're right. There is abundant liquidity, and conditions are really not getting tight. And you just have to look at the resurgence of crazy things happening in the NFT space, for example, to tell you that rates are not tight enough. They're just not, because this sort of thing does not happen when money is tight. So, for people trying to understand how the plumbing works, unless you really, really want to go down the rabbit hole and devote an awful lot of time to understanding very arcane things, the simple thing is to look for signs like that. Look for signs of what Alan Greenspan famously called irrational exuberance. If people are still buying monkey JPEGs thinking they're going to triple their money, rates, monetary conditions are loose. It's just that simple. You don't have to get any more complicated than that and go down the rabbit hole. When you see the price of assets that work really well in a zero cost of capital environment start to perform terribly, then you know that there is a tightening taking place, and that's the important thing to figure out. If you want to go into the IOER and you want to go into the RRP and you want to go into all these arcane little corners of the financial plumbing, unless you are correctly disposed to going down those rabbit holes, you'll just give up because it's too complicated, and deliberately so.
Yeah, I think deliberately so is the right way to look at that. So I want to talk now. Let's rotate the Rubik's Cube. I want to talk about this from the direction of narratives. And it's just fascinating to me. COVID taught me a lot about the power of narratives, or
Sure.
the illegitimate power of narratives, right? So, you get things just dead wrong, but people all sort of share that narrative, and it's what you get. I'm very worried about things like, I think we've got a green energy myth. I think I would like to talk to you about some narratives around those things. But again, the fractal to help me understand this. One of the most astonishing things to me was watching coming into COVID in February of 2020, WeWork, which I've been waiting forever for this thing to go bust, right? Because
You and me both, brother.
it was just a bad idea, right? So I watched their bonds spike to 20%, right? I'm like, oh, this is it. This is it. And then from March of 2020 all the way through to the end of 2021, those bonds went all the way back down to par, pretty much, like 8.75%. And then over the next, then they ended up at 99%, interest rate and completely dead. But I was just sitting there going, hold it. The entire premise of WeWork, from every standpoint, is completely broken. Nobody's going back to work. If there's any sector of real estate that's going to get monkey hammered more than any other, it's going to be office space. And their bonds went from 20% down to 8.75%. So who's buying? I mean, that's just somehow the narrative. I don't know what happened. Maybe I should just rewatch The Big Short and realize this was big banks gaming something. But
Well, look,
it was astonishing.
Yeah, I don't necessarily think it's big banks gaming something, but again, let's look at incentives, and let's look at this through through a practical lens rather than, and I think a lot of us immersed in these markets tend to look at these things through our own lens, which is colored by a deeper understanding of financial markets and how they work. And when things don't work the way they're supposed to work, i.e., all the reading, all the learning, all the experience we've had tells us this is how the world functions. When it doesn't function that way, we get really kind of bogged down in trying to understand why and trying to figure out, well, this just doesn't make any sense. And it completely rattles us because we feel like we have a degree of certainty about how certain asset classes will react to certain incentives, certain headlines, because we've got years of experience. So, in COVID, when you look at WeWork, and like I was talking about WeWork for ages, and this will ultimately, this has to go to zero. It just doesn't work. Before COVID, COVID, to your point, was the one, okay, this is it. Finally, this is where it's going to meet its maker. And of course, ultimately it did. But we saw a lot of this in COVID. We saw all this with AMC and GameStop and all these things that people were familiar with, and everyone heard of WeWork, right? A lot of people worked in the office. If they didn't work in a WeWork office, they saw WeWork blazoned on big buildings, and there were a lot of people talking about WeWork. It was a thing, right? WeWork was a thing, and people were aware of it. And so when you have all this liquidity sloshing around, you have a load of people who are sitting at home with cash in their pockets and no work to do. We do see GameStop, and we do see AMC, and we do see all the meme stock craziness of that period. And what was it that was most impacted by that? It was all these things. It was AMC. It's the movie theaters that people are so familiar with. And instead of looking at the balance sheet and the debt profile, they go, the movie theater's great. I go to the movie theater every week. I mean, who wouldn't want to own the movie theater? I'm never going to stop going to the movies. So we got to this point where fundamentals just didn't matter. They just didn't matter. It was all narrative. And if the narrative was on an individual basis, i.e., I love going to the movie theater, therefore the movie theater is not going to go bust because I go every week and other people go every week and there's always people in there. It's never going to go bust. And I love AMC, therefore I can buy some of these shares because, hey, they're going to go up because of people like me. It has an extraordinarily powerful effect. The perfect example is Hertz, right? Hertz trading up in bankruptcy, right? I mean, it's absurd what happened. But as a financial market participant, you're sitting there going, this makes no sense at all. And it didn't. And ultimately, financial gravity would assert itself. But in that moment, you talk about narrative, in the moment when the narrative was, wow, Hertz has fallen from 30 to 6. It's Hertz. I rent Hertz all the time. If it goes back to 12, I double my money. Bankruptcy didn't matter. It was all about the number. It was all about the number on the screen. It was all about the stock price. And a lot of people with trillions in stimulus dollars got behind those. And we saw what happened with Gabe Plotkin. We saw what the Roaring Kitty stuff did to him and his hedge fund. And this narrative of sticking it to the man became such an important rallying cry for people who believed in that narrative. Now, if you take a look at the share price of AMC and GameStop, you can see exactly what's happened over time. When the narrative dies down and people aren't talking about these things anymore, the narrative's dead. Guess what? Financial gravity reasserts itself, and they're all back down to pennies.